Well, welcome. I'm delighted to have you join us either in person or watching this and recording. I'm RJ Kelly. I'm founder and chief visionary officer of the Wealth Legacy Group in lovely San Diego, California, with clients in 19 states and more being added as we go. And I'm delighted to have a special guest expert with me today, Rich Salerno. I'll tell you a little bit more about Rich in just a few minutes. But Rich, thanks so much for making time to be with us. I know you got lots of places that you could be, and I appreciate your being here with us.
Thank you.
So let's get this thing rolling. Let me pull up our presentation for today. And as I was explaining to Rich, for me, I like to do these webinars, number one, because it provides great content for our clients, but at the same time, it also helps me in learning these concepts better as well. So today we're going to talk about better cash management, whether that is in your business primarily, or whether that may be for you personally as well. I want to also introduce the concept that we could potentially benefit having some key employees covered under this program. And at the same time, if you have bankers in your life because you run a business, this will promise you, this is going to make them happier too, and a few more things as well. So with that, let me do just a couple of quick introductions. First of all, myself. I've been in practice over 35 years. My specialty is working with privately held pre-liquidity business owners and successful individuals, entrepreneurs, professionals, and also franchise owners and executives. So I created something called Critical Actions Roadmap and a Wealth Legacy Assessment. Basically, my father died when I was 18. He had created a multi-million-dollar business that unfortunately went bankrupt 10 years after his death. And I watched firsthand when the visionary dies and what happens to the business. And unfortunately, without proper planning in the various aspects, estate, business, tax, insurance, so forth, in most cases, the business is going to die. Maybe they don't even wait 10 years to die, as in our family case, but invariably the business is not going to last generationally. So that's what we created, is something that we dig into various aspects of the planning cycle. We have an attorney on staff. I've got a master's in financial services with a subspecialty in tax reduction and a host of other credentials after my name. And we've got a wonderful, amazing crew that helps us and put together these critical action roadmaps. And so again, there's a number of ways that you can also sell appreciated assets, where maybe it's a piece of real estate. Just this morning, I got a phone call from a wonderful commercial real estate friend and advisor who has a client who has a multi-million-dollar sale. And she wants to know, are there ways that she can either reduce, defer, or eliminate the tax on the sale, capital gains taxes on the sale of her appreciated building? And the answer is yes, yes, and yes. So we do a great deal of work in that area. Love to talk to you if you have a similar situation. Either you're selling appreciated real estate, we've got a $41 million farm right in the middle of being able to sell and not have any tax. Capital gains taxes are an optional tax. You don't have to pay it, and you won't go to jail if you do something else instead. Or maybe you're selling a business and you want to, again, have a conversation about how can you do that and not pay tax. In addition, what gets me out of bed in the morning is a life goal to facilitate $1 billion for philanthropy. We crossed $100 million in August of 2012, and we're well on our way for our second $100 million. And if the Lord should tarry, granted long life, we'll continue to work towards that $1 billion and have some very exciting stories to share with you about that. But speaking of exciting stories to share, I've got a really great one that you're going to get to hear more from in a minute, and that's Rich Salerno. So Rich has a wonderful pedigree in terms of sales and marketing. He worked previously with the huge company called AIG and also Sun America, and on their sales and marketing side and leadership role there. And prior to that was with another, in fact, a group that I had business with a number of years ago as well. Crump Life Insurance, one of America's largest life insurance brokerage firms, period. It's a tremendous organization with some really outstanding quality professionals on their team. So Rich was in leadership role there as well. And so his passion is in being able to come around to various life insurance offices and help coach them into how to get greater performance, but at the same time also finding new areas and avenues to open up for sales and resources. So I got a call from a wonderful client of mine, and he's got a couple $1 million as laying in the company, and the the bankers that they build homes. So the bankers have lots of lines and they want to make sure that money sticks around on the company balance sheet. Just because, hey, right now we may be in a recession. And if you're a home builder building 300 to 350 homes a year, that's a lot of product. And so bankers get really nervous. They are just by nature nervous people. No offense intended. If you're a banker watching this video, I'm sorry, no nervousness. Maybe a different word, just cautious, shall we say. But he was getting quotes for 1/3% to earn on these millions of dollars. But part of it was because the biggest issue is that he wanted liquidity, because if they need it for emergency or opportunity, they need to be able to call on those reserves. So today I've got 3 goals for us. One, we want to learn how we could potentially earn higher rates of return on liquid cash, have it not be taxable until you take it out of the account, take it out of the wrapper. But this would be for money that's either your business or personal side that's idle and underperforming. You could, if this is a business scenario situation, you could use potentially some of the earnings from this bucket to put up what we call a velvet handcuff in place for key employees. I've never seen more movement than today with people. There's roughly 2 jobs for every individual. And even with a slight retraction, we had 400,000 jobs reduced since March of 2022. So there's 400,000 people left the workforce, but still there's 2 jobs for every person. So how do you provide things to keep these significant CEOs and other important staff and members of your team? How can you lock them in better? Well, one way is to create a velvet handcuff plan, or what I call an exchange of promises, where if they promise to stay with you for the next 5 years, 10 years, tell me today, then you in turn will provide them additional benefits for in the event of death, in the event of disability, and potentially in the event of retirement. You'll add some additional money in their pocket. Well, you can use earnings inside this program to be the funding instrument to pay those benefits. At the same time, you also, if you've got key employees in the business, and God forbid one of them was killed, or maybe several, bankers get really nervous, especially if it's you as the key employee that gets killed. So how can we protect the business and help your bankers sleep at night better? And the last thing we're going to learn today and look at is, what are some ways, given the fact we're living longer today, but the things that used to kill us don't kill us, but we have more what we call chronic illness, we have critical illness, and then also in those situations where someone is dying, life insurance used to be just for death for the family, but is there a way that it can be used today, even if the person is still living, but in a terminal situation? And the good news is Rich is going to tell us all about that in a few minutes. So why today? Why are we doing this event today? I'm with a wonderful group of national advisors, the Elite Producer Group, or EPG, headed up by the amazing Tom Toos. But Tom invited me to come to a study group meeting, and there at this study group, he brings in various subject matter experts, people like Rich. They're very, very high level, senior planning level ideas. And so I saw this idea that Rich shared. I thought, boy, that makes so much sense. Little knowing that short time later, I'd get a phone call from one of our dearest clients saying, hey, here's our situation. What can you do to help us? It was like, you know what? Got an idea that might really fit well. So that's really what prompted this today. How can we turn idle assets into smart money? And using a very specialized, customized program and product built by frankly, one of America's most innovative, clever insurance companies out there, North American, out of Chicago, really bright. And so not only can we make your money work harder, but we can address some other risks too, like market performance and also liquidity needs in the business. What about inflation risk on your assets? Obviously, if you're only earning 1/3%, you're falling behind inflation, especially when inflation, 8.1 and 9.1%, we're falling way behind. So let's try to keep up or ahead of inflation. And then also, what about some of these healthcare risks? So we're going to look at a couple of examples. But if you're a business owner, it could be on some cash accounts that you've got excess cash that's just sitting there, you need it. Maybe it's for bonding purposes, where your bonding company says, you got to keep this much in cash. Well, okay, you're going to do that, but what can you do to make a reasonable rate of return on that? Maybe you got some money in annuities that's earning nothing, money market accounts, so forth, or maybe you just got an inheritance. All of those are examples. So, Rich, why don't you walk us through what is this very clever, very innovative product that North American has built?
Yeah, that's great. And RJ, thank you for having me and welcome everybody on the call today. I couldn't be any more delighted to be on this and I appreciate the invite, RJ. And I'll start by saying, yeah, I've been doing this and I struggle to calculate the math because this will be my 26th year in this specific field. So I've seen a lot of changes, and I can tell you the products that we've built, not just at North American, but in our industry altogether, are second to none. They've really come a long way from where we were, let alone 20 years ago, to even up to 5 years ago. And this innovative product, that we call the Smart Builders, is really one of its own. There's not a lot out there, but you could see on the slide, it is a no-load product, meaning it's minimally, the expense charges on this product are minimal. We've exited and eliminated most of the load through various mechanics of building the products with a lot of the index companies that work with us to allow us to have a no-load product, meaning we've removed a large portion of the fees on the product and built them into the insurance piece of it that allow the potential accumulation on this product that we'll see here shortly. But we've innovated it with adding a number of those upside potential index options. So everything from a volatility fidelity index, which is proprietary to North American, an S&P 500, the NASDAQ, the Euro stock. There's a number of indices on there that really give you the options as a policyholder, where you can choose, depending on the market and the conditions, and obviously, RJ, conversations with your office of what sectors are the ones to be in or not be in. So we've added a number of those options for flexibility. What we also added on this product, and we'll touch on this also as we talk about it, is a waiver of surrender option. And as we look at some of the numbers, I can share what that actually is. But that really is allowing us as the policyholders to have full access to the liquidity of the accumulation that builds up inside of the product with no charge whatsoever. And there's a number of different options. And of course, as I mentioned, we can get to that as we look at some of those numbers. Okay. And the last one is, in my opinion, one of the very most important is the living benefits. And that's by way of critical, chronic illness, as well as terminal. And we'll touch on each of those as we go through it as well. And why I think it's maybe the most important piece is if you look at what typically would be a product with living benefits, chronic and critical, we think of long-term care insurance. Well, that's not really such an accessible product anymore these days, which is why you're hearing more about living benefits on a life insurance product more than anywhere else in the industry. And again, going back to what I opened with of innovation, I can tell you when we saw that long-term care market becoming really a struggle for the average consumer of those products, we innovated our life insurance products and accumulation products to include these to really safeguard and protect current as well as future assets for you.
Yeah, it's very, very clever, which again is one of the things that caught my attention. So first, we're just going to take a quick peek at a 56-year-old. He's an entrepreneur, he's a home builder, and I mentioned at the outset, a couple $1 million that is on the company balance sheet. But he wants a higher return, but at the same time wants to keep the contract liquid, or wants to keep the money liquid as possible. So I reached out to Rich, and Rich, we're going to look at a couple of different accumulation proposals here. One at 3%, and then another one at current rates. So walk us through this. Here we just made the assumption that we would take 500,000 of that 2 million. And then with another $1.5 million, there are a number of other investment type of tools that will also be very safe and liquid. But this is taking out a chunk and moving it off to the side into this special program. So Rich, take it away.
Yeah, appreciate that. And yeah, and great point there. So 500,000 of the pool of money is allocated to this scenario, this product. And really what I like to highlight with that is this really is a product when you look at the accumulation that speaks more to leverage than anything else. Right. And you look at that $500,000, in year one. And just as a note, RJ, I know you and I talked about this a number of times. This product is designed to bring back that first year premium in first year accumulation. Mm-hmm. So you can see the numbers there. Year one, account value is 512. Surrender value is 499,647. Point to that is 500,000 goes in. By the end of the first year, in this hypothetical scenario, those are the numbers you're going to see. Will it sometimes be, net cash surrender value or account value? Will it sometimes be higher or slightly lower? Could be, but it's going to be very close to that first year premium. What this essentially means is you can look at those columns right there, that account value, the net surrender value, or the death benefit. When you look at that, one is that death benefit, which I like to start with first, is really showing the protection of the product, right? So if you take a piece of that out, that death benefit, obviously tax-free to your heirs, that protects the asset for you as well as your beneficiaries. And I like to talk about that first because that's really the power of the product should something happen to you. You're protecting that, whether it's an offset of taxes, or whatever comes out of that money to the beneficiaries, great. But really where the substance is the living years and what happens during the living years. And RJ, you mentioned earlier that, it's not a death benefit product 100% of the time. They're created as living benefit products. And that shows on this slide as well as a number of the others. But you see that net cash surrender value where you have complete access to those assets. And that's just showing in year one. What I like to highlight is, when you go, whether it's the 5th year or the 10th year, and you could look down that list at line number 10, you can really see where the accumulation grows on this product. And that's really for you where that leverage comes into play, where you can utilize those assets and take distributions off of this policy at the account value level, where, as you mentioned, RJ, maybe in year 3 or 4, there's some sort of repair or whatever you need to do as a business owner. You now have the leverage to go in and take a tax-free withdrawal out of this. Could it be to offset taxes? Of course. Could it be to a new plant? Could it be for inventory controls? Whatever you choose to do with the assets inside of this policy, that account value is the assets you have available to you, tax-free withdrawal. Doesn't need to, again, this is your assets. North American will send you the check for whatever you request. But the power of this is just to show you what assets are available to you for whatever purpose you need to pull them out of the contract.
And Rich, what I like too is the fact that even at a very, very low return assumption, the 3%, it still kicks out a lot of cash, even in those early years, as we're talking about. So you mentioned earlier about different riders, and sometimes people get confused, like, well, if we introduce like the S&P index, or we introduce something, isn't that very volatile? Well, you all have come up with a very clever, along with Fidelity, have come up with something that is very specific and only for North American, called a volatility control index. How does that work, and what's that?
Yeah, it's a great question. I really appreciate it, because the fact of the matter is when you look at, and I can tell you industry-wide, about 80% of all premiums paid into an index universal contract go into the S&P. And the simple answer to that is, well, because it's the best performing index in the history of index.
Yeah,
right? And the numbers don't lie, right? So it performs very well. What you also see is the Fidelity index, and we call it a 5% index on Fidelity. And the reason for that is when you look at the markets today, they are very volatile, right? So you're going to see that we could see them going up and down each day. Causes a little angst in the marketplace. So we wanted to make sure that we included an index on our products where that 5% is the target number. So and it's made up by various investment groups, anything from bonds all the way through to more aggressive index, but it's managed by, or more aggressive investments, but it's managed by Fidelity. And the goal on that product is to hit a 5% return. Now, why do we like that is because you have full flexibility and options as the policyholder to make changes in and out of that index if you choose. If you like the S&P and say, look, I understand the ups and downs and I could stomach that, let's do it. For illustration purposes, we always like to illustrate the fidelity. And again, because it's a little bit more of a conservative approach, in this example, we illustrate at 3%. Really, again, the target on that index is 5%. So we always like to be a little more conservative to show you that, hey, these numbers look fantastic, and they're conservative by all accounts and historical returns. They still show very conservative for us, but it's a, my opinion, it's just a very safe, comfortable scenario.
And how is that different than this one at the 6.16%?
Yeah. So what we do, there's a maximum that we can really from insurance law illustrate on a product. And this is the maximum return, maximum rate you could see up there at 6.16%. I can tell you that could it be higher? Could it be lower? All of the above, right? Even at 6.16, it's still a relatively conservative return for the life of the contract, whether it's 10, 20, 30 years. But this is the max charge that you would, or the max illustration rate that you would see from North American, where we can max illustrate this at 6.16% return, as opposed to somebody that might illustrate at 10% return, where in my humble opinion and experience, 10% illustration rate probably isn't going to be very consistent on an annual year-to-year basis, where at 6.16 being the max charge, again, I still think it shows relatively conservative, but we like to show what the max illustrated rate would be.
And that's based on your returns using the S&P index. And so this is something that you can back up and say, yep, here are the numbers. This is what we did. So that's why you
right.
show that.
Our actuaries back test all the numbers, go back in and say, okay, look, on a conservative max illustrated rate, we're still being conservative.
Well, and let's look at the next example, because we can take a look at how that looks as well. This was an older female, still very young, 65. Holy cow! That if she's going to 120, she's barely halfway there. She had $250,000 in cash that was, again, just idle, not doing much. And so she wanted to make that money work harder. But at the same time, she was also very concerned about risks for her health as she gets older. She's a single female.
Yeah.
So we're going to take a look at this, both in terms of, we're going to look at it big picture, but here we've got them side by side. There's that volatility index from Fidelity you were talking about a moment ago, but also even at a very conservative rate of 2.5%,
right,
the account still does really well.
Right. And this was a great example in a live case study on a case we worked with the client. And like you mentioned, RJ, the concern here was, this is half of the idle assets that she had sitting in various instruments, CD or a money market. And the proposal was, if you like that, we would look at possibly half of that, in this case, $250,000 that goes in. And as I mentioned earlier, you can see on that surrender value, we're slightly under that 250. But within the second year, we've made up for the reduction or the offset there. So $250,000 in year one. At the end of year one, $247,000 in net surrender value. But you can see how those assets continue to grow for her. The unique thing about this is, her concerns were, the comfort of knowing those liquid assets are there is what helps me sleep at night. The reality is they are idle assets. We most likely will not be using those funds, and they will get passed on to her heirs. We offset a number of things with that by using half of those idle assets to offset, one, at death benefit, any of the taxes that her beneficiaries may inherit. Well, we emphasize two other things. One, the liquidity of this product. You still have access to that $250,000 and then some. What we're also going to, which we'll speak about here momentarily as well, we're also giving you a third component, and that's the living benefit. kind of what I would call that hidden cost of living. How am I going to pay for some additional expenses that my health will present to me along the way? And we've given her a third component that we'll talk about momentarily in this scenario.
Well, and I say, when you look at the numbers here, even just in 10 years, 290, 370, those are very strong. And actually, you can see that the surrender charges are taken care of. They're gone over 10 years. So very, very strong numbers in terms of growth. So Rich, why don't you walk us through, we're going to talk about those three things: critical illness, chronic illness, and then terminal illness. Yeah. So how does that work?
Yeah, thank you, RJ. This is a great question. This is the third component that I had mentioned. When you move those idle assets, we're offering obviously the liquidity, the security of the death benefit, and this is the third component that I can't emphasize enough. And I'll tell you, in my long history in this industry, this did not exist up to probably about 6-7 years ago. Now my recommendation to anyone I speak with is, any contract you look at, make sure this is included in there. And I'll tell you how they work. So it comes with three of them. The first one is critical illness. And that is 5 events. So when you think of critical illness, it could be, the 5 events are a heart attack, cancer, stroke, organ transplant, and kidney failure, right? So those are the 5 triggering events. Now, what it happens,
one of those, right, Rich? It doesn't have to be all 5. It could be
one of those per event. Let's hope we don't each get each of those events through our lifetime. But the reality, and we've seen the statistics, the most common, obviously, are those first 3: heart attack, cancer, and stroke. And we see a lot of our, our distributions in critical illness going towards those 3 areas. Why is it so important for this? Is you can see how the numbers work: 25% of face amount up to $50,000 per event, up to $1 million, or a $2 million total policy max, meaning it could be critical and chronic event. But how it works, and here's the most important piece of it: this does not impact or affect your accumulation value inside of the policy. Rather, this is a reduction of death benefit. So in that previous example, if you have let's call it a $500,000 death benefit, and you have one of these events and it's a $50,000, let's call it a $50,000 triggering event, we do what's called an indemnity, where it's a reduction of death benefit. So now your new death benefit would be $450,000 instead of you actually having to go in and take money out of your accumulation value. So we reduce the death benefit, not the accumulation.
That is terrific, because that way also leaves cash for those things that we just don't know. If someone's in a critical illness situation, there are lots of different expenses that were unplanned for. And as we know, that since 42% of Americans couldn't even come up with $1,000 to pay an unexpected healthcare bill, if it goes up in numbers above that, that's where this makes such good sense, that having this critical illness rider. So what's the difference between that and the chronic illness rider?
Yeah, now the chronic illness, and again, the first line, no additional premium, something that's worth mentioning is, on all of our contracts with North American, whether it's a term product right through this product on our IUL suite of products, they are automatically included on our products, meaning you're going to have them. Whether you elect to use them or not will be at your discretion as a policyholder. If you use them later on, then obviously there's a reduction of that death benefit, but they're going to be included for no additional premium. Knock on wood, hopefully nobody ever has to use them, but the reality is you probably will want to at some point. The chronic illness is really for those chronic illnesses, and I think often, I have a very close friend that just initiated her chronic illness because of Lyme disease. Right. So it's things very simple like that. It could be multiple sclerosis. I mean, you think of a chronic illness, but really what happens is if it gets severe enough, what we say is the 2 of 6, what triggers the event is 2 of 6 daily activities of daily living or cognitive decline. What is activities of daily living? Anything from bathing, showering, dressing, getting in and out of bed or a chair, using the
Toileting,
toilet, eating,
food. Yeah.
even
Mhm.
even walking, right? So those are activities of daily living. If two of those six are impacted whatsoever from the illness, that triggers the event. And here it's, again, just particulars of how it works on a chronic illness, maximum of 24% of face, up to 480,000 per election. So it's a pretty healthy benefit to receive up to 480,000. Doesn't mean you need that in one election, or hopefully you won't, but you have up to that. And again, combined max of 2 million. So if there is a triggering chronic and critical event throughout the lifetime, we'll allow up to 2 million of max. And then finally on this, it's the minimum is going to be the lesser of 5% of face, or the election of 50,000. So there is a somewhat of a minimum there, but that's how the chronic illness works.
And Rich, you talked about, and I believe you may have mentioned this a few minutes ago, but it's such an important point. I want to make sure we really unpack it. And that is the fact that North American, it's an indemnity as opposed to reimbursement.
Yeah.
Can you unpack that for us in terms of why does that matter?
Yeah, RJ, I'm glad you brought that up, because it's and I always highlight to my clients especially as well that it's a very important factor in something like this, indemnity versus reimbursement. And I'll just real quick identify, explain the difference in the two. Reimbursement would be, let's say North American coming and say, okay, you're submitting a claim for a chronic illness. Show us where you spent your money.
Mm-hmm.
We're not concerned with that. We are indemnity, meaning if you submit a claim, whether it's chronic or critical, North American will verify with the facility that you have seen. So, whatever clinic it is or whatever doctor it is, we'll verify with that office that the condition does exist, and that's all we look for. And at that point, then we will reimburse our policyholders whatever that claim would be. So if I submit a claim for $20,000 for a condition, North American will verify at the clinic. Once it's confirmed, they will send out a check, reduce the death benefit, and send the check out to me that equates to the $20,000 that I requested. So we're not looking, for the reimbursement. Once you get that check and you've paid for whatever expenses that occurred during that illness, you can go ahead and put that money back in your savings account, or pay down some other debt, or do whatever makes the most sense. It's your money, 100% up to you what you want to do with it at that point.
It's a lot more flexible, obviously,
Very
to do it this way than having to go through and give them dimes and dollars and 15 cents for parking over here, although where do you park for 15 cents? But so let's go to that third aspect, which is terminal illness.
Yeah. And this one, again, no additional premium required, but really this is quite a common feature on most contracts today. If there is a 24-month life expectancy, and in most states, I say in most states, I think there's one or two that have some restrictions. It may have to be a 12-month or a 36, and I think that's Alaska or one of the others. I'd have to confirm that, but 24-month life expectancy, meaning in the unfortunate event that something happens where as the policyholder, you have a very limited amount of time left, usually a terminal illness, end of life sort of illness, you can accelerate the death benefit prior to the event. So that's the terminal illness endorsement that says we understand, the inevitable will happen. We'll waive the premiums on what's left of the benefit, and we'll accelerate on that bullet point. We'll accelerate up to 90% of the face amount, that you can use towards those expenses prior to the event actually happening. So it really is an end of life, just a security feature as the inevitable will happen. So it's one that's somewhat awkward or hard to talk about, but we want to make sure that the flexibility is there for the preparation and the planning, and that's the terminal illness endorsement will include on the product.
And that applies to both your term insurance products, which are also incredibly sophisticated, but also incredibly competitive price-wise, as well as your permanent products, right? So it's your whole suite of products. It's great. And what's it mean that it's discounted at time of election?
So what happens is I mentioned earlier that you don't pay for this in your premium. So the flexibility of this becomes If you never use any of these endorsements or benefits, chronic, critical, or illness, you'll never pay for them. At the time of election, what that discounted rate is, where as the policyholder, you might come in and say, I need $20,000. Well, we understand that there's a cost of it associated, and that's called the discounted rate. So it's calculated at the time of distribution, often depends on the age, the rating of the policy, where our actuaries will look at it and say, okay, if you need 20,000, it may be 25,000 we take off of the contract to pay for it throughout the entire life of the contract. So it's, even though you're not paying for it in the premiums, when you exercise that, there is a cost associated with it, and that's what's called the discount. We call it a discounted rate at time of election.
I see. And what I love about this terminal illness rider, as well as the other riders, is, but especially for terminal illness, is in those last days when a family is struggling just to find that way to have a few treasured memories yet. If they look back and they go, gosh, we had some great times together, but I just want more. Having another 500,000 or 250,000 or a big check be able to come in while the person who's dying is still alive, that they can use that money to go on a final trip together. Or maybe it means putting a ramp in it at home, or maybe it means that we've got more care that can be provided. Maybe it means that family members that couldn't afford to come from the East Coast, say out to California, great. So the family can pay for those costs. So that truly it becomes one of those things that really adds more memory, more life in those last days when things are so difficult. So last couple of points here, there's something that, again, North American has something called accelerated underwriting, which is really quite clever. So walk us through that.
Yeah, so accelerated underwriting is, and again, kind of going back, dating myself in the industry, and you kind of think of a life insurance product, and rarely do you think about all the elements that now come with it as a living insurance policy. The accumulation, access to it, the living benefits, the protection there, and of course the death benefit protection. But we've made it really easy to secure the coverage. And you can see right on the screen, we call it accelerated underwriting. And when an electronic application comes into North American, we will submit that through what's called our accelerated right-of-way underwriting program. And what simply that means is anybody from the ages 18 to 50 up to $2 million of face amount, 51 to 60 up $1 million, will go right through our streamlined process, no blood, no urine. If you're a standard health risk to preferred best, I can tell you, RJ, our cases are going in. My chief actuary or chief underwriter tells me all the time, we're at about a 24 to 48 hour turnaround time.
Wow.
So from the minute of application to the minute of approval, 24 to 48 hours. But again, no blood and no urine. So it's a very less invasive procedure, or I shouldn't even say procedure, application process, which is very quick. We offer it on all of our products. So it's just really easy. If you had told me this is what it was going to look like 15 years ago, 10 years ago, I'd say you're out of your mind. But with the technology today and the innovation in the financial world, we're doing a lot of cases come in, accelerated underwriting, no blood, no urine, and you're approved for your policy, and we could apply those premiums to start that accumulation for you.
Extraordinary. We've got some cases that have taken 6 months, 12 months. Just got one finally placed for about 1.5 years, I think.
Yeah.
So we're going to definitely have to have some more conversations here, Rich. So thanks. I think we've really identified, there were some questions that had come in ahead of time, so we've tackled those. So today, just to kind of in summary, we've looked at how can we make money work harder. And in this time of high inflation, and increasingly now higher taxation that's being promised by our administration, how do we make our money work harder and be on a tax-deferred basis? And that's one of the things we didn't touch on that I recall, is that this money, while it's growing, there is no tax on that money until it's actually taken out of the contract. So again, great way to get your money working harder. And then if that money is used to pay for a key person benefit, then that money, although it's taxable, you get a deduction for the money that you pay out to that key employee under a velvet handcuff plan, as we've talked about. And again, whether you are the owner of the company, whether you have some key people in the company, this is a great way for you to help your banker sleep better at night, knowing that if God forbid something were to happen to you or one of your key people, in walks some tax-free money. The death benefit on these products is income tax-free, capital gains tax-free as well, I might add. So even though the earnings would be taxable and withdrawn, the benefits, the death benefits are income tax-free. And last, we looked at how this very clever product addresses some of the other concerns. We're living longer, but we're having more things happen to us. And that's where having chronic critical care and terminal illness benefits built in automatically. No cost unless you use them. That's why it makes such good sense. So with that, I want to thank our subject matter expert, Rich Salerno. You can see why he is so accessible and excellent in what he does to build agencies up and help them open up different avenues for meeting clients' needs that they hadn't been knocking, some doors to knock on that they hadn't been knocking on. So Rich, thanks so much for being with us. I really appreciate it. This was very helpful to me personally to learn more, as well as for those that are watching our event today.
Well, thank you for having me.
So with that, I'm RJ Kelly, Wealth Legacy Group in San Diego. Thanks so much for being with us. God bless, and go and make a life serving other people and make a difference. Bye for now.